Does this work? Hello? Yeah, okay, good. I got an email from someone who suggested there was some confusion about whether we're having class today, but probably the folks who are here, I guess by definition, we're not confused. So anyway, I was in the UK beginning on Thursday, which is why if some of my sentences feel like they're in another planet, it's probably the jet lag from returning late last night, but speaking thing. And it was about 55 degrees, and the museums were packed over the weekend, so the city is alive and well. I'm going to turn today to the efficient market hypothesis, EMH, as it's called. This is a really important topic, and it's obviously important for M&A, given the conflicting claims that you hear about whether a bidder's price, which is by definition going to be at a premium to the market price, is able to undervalue the firm. What does that mean? Efficient market hypothesis is very important when we try to evaluate a claim that stocks today are trading in a bubble. We're in a bubble. What does that mean from EMH terms? How could we have had the dot-com bubble? Everybody concedes that that was a bubble. We aren't quite sure as to whether we're in a bubble yet. We'll know that in maybe tomorrow, but we won't know it for a while. But we did believe we had a dot-com bubble. How could that have happened if markets aren't in any way efficient? How could we have had a financial crisis to begin with? So anyway, I hope we'll shed some light on not only the issues that bear specifically on M&A, but things that bear on how one thinks about the economy as a whole, and the way that, in a sense, part of the bottom line, the punch line here is the law has a lot to say with whether bubbles can exist or not. All right, so let's see. Some folks were obviously confused. Let's see who's here. Christian, are you here? Yes, you're here. So, good. What does EMH mean? The mic, please. When we say markets are efficient, let me put it differently. When we say markets are efficient, or we say the bidder's offer for the stock is certainly suggests that the bidder's motives are to create value for the firm because the markets are efficient. What do we mean?
Can you repeat that one more time? Sorry.
I'm sorry?
Could you repeat that one more time?
Yeah. I'll put it in a simple way. How do you understand the claim that markets are efficient, stock markets are efficient?
That you can't really game the stock market by looking at past values, and that all publicly available.
I'm sorry, say again?
You can't profit or beat the market by looking at past trading values and things like that. That the market has already accounted for all publicly available information.
Well, wait a minute. Is that the general claim or one of the sub-claims?
I think the second part was the semi-strong claim, and the first part was the weak form.
All right, except what is the bottom line part of the claim? I mean, in other words, what you're saying is when you refer to stock prices. You're saying you can't look at a particular set of information, stock prices, and do a better job at predicting market price. But what's the general claim?
I don't actually know how I would.
I'm sorry?
I don't actually know how I would put the just general claim.
The general claim. Anybody want to put the general claim in a different way? Let's see. Young Lee. Any way to put the general claim?
I guess the way that I would put it is when there's a certain amount of information, the market takes it and it uses the information to reach the true price.
What do you mean by the true price?
Like the actual value that, for example, like the actual value that the firm would now provide given this set of information, like to the society.
I'm sorry, the last...
Like the actual value that the firm has in like the wealth of the society. Just.
Oh, all right. So we'll say today's stock price is the best measure of the firm's intrinsic value, let's say, right? The measure of the firm's the firm vis-a-vis the wealth of society, which suggests that in some way you're thinking the stock price is a predictor of the real output of the firm, the earnings of the firm, the dividend stream of the firm, the economic output of the firm, and the stock price, which reduces to present value that expected future earning stream or dividend stream or value stream, however you put it, right? And that's what the stock price is all about.
Right.
Okay, so that's your view of the stock price.
Right, and I thought, going to the efficient, I thought that like the market takes information and uses it, incorporates it, and like changes the stock price to reflect the true intrinsic value.
All right, and so there's information which is produced in some way that is impounded into the stock price. And what the stock price measures is the expected future earning stream or output stream of the firm. All right, now, is that the same idea that Christian had in his account? Christian, let me ask you, is that the same idea that you had in your view of efficient market prices?
I would say so. That the information is impounded into the stock price and sort of predicts.
I'm sorry,
Yeah, that the publicly available information is incorporated into the stock price and sort of predicts the market's view of its future value.
the information, publicly available information impounded into the stock price. But wasn't there an additional kicker that Young had in his account? What did he say the stock price stood for? It was the real economic value of the firm, the intrinsic value of the firm, right? Is that what you think the stock price stands for?
I think that's what the efficient market hypothesis is claiming.
Okay. Is there a different version? Yeah. Whoops. Margaret. Yes.
Actually, Maggie.
I'm sorry?
Is it actually Maggie?
Maggie. Okay. Go ahead.
I think we've gotten at this, but I just thought that.
Mike.
Sorry.
I think we've gotten at this, but I always just thought the efficient market hypothesis was interesting because it's like it kind of raises the question of whether or not people who basically invest as a job can actually add value or not. And a strong version would say no, because the information's all already incorporated, and you can't make. And it was all about like whether or not the information is really accurately reflected. And I always kind of disagreed with it because I think we
I'm sorry, whether it was
really accurately reflected in the stock price, and I always thought it was clearly, from a real world perspective, it was clearly borne out that it's not, that at least the strong version is not true, because you have these firms that beat the indexes year over year over year, and maybe it's random, but seems unlikely.
right.
And so, so I guess the controversial aspect of it, or the interesting aspect, I thought always just had to do with whether or not, like, can you actually pick stocks and do better than, a random monkey picking stocks?
Actually, that's not the part about which there is the greatest dispute. Right?
Okay.
Right. I mean, and so remember what Young said the stock price was predictive of, which is the real economic value of the firm.
Right.
What is the vision of the stock price that you are implicitly describing?
Sorry, I don't know.
Well, what is the stock picker trying to do?
They're trying to, they have a position based on maybe macroeconomic trends or
Right.
something they know about the industry, and they think that other people haven't caught on yet.
Okay. And what are they trying to do?
To, depending on what they're doing, like precisely, make an investment and then sell it at a higher price later on.
And how are they paid off? I mean, how do they win?
They win by selling the stock later.
So what is their use? Right. I don't mean to. Well, I do mean to push the point. The stock picker, the person who is using the information to buy and sell stocks, cares about the information for only one thing: whether today's stock price is the best available measure of what tomorrow's stock price will be, or the day after tomorrow. In other words, the thinnest version of EMH is that today's stock price is the best predictor of tomorrow's stock price. It's only about the informational efficiency of the market, the extent to which the information that is available, and we'll discuss the kinds of information that one might consider, whether the information that is available is impounded in today's stock price or not. Whether you can make trading profits on the basis of the information that is knowable today. And so the EMH claim, in its kind of thinnest version, is only that the market is informationally efficient. It takes all the information that is available, and we'll discuss the various types of information you might use, and impounds that in today's stock price. So, as Maggie said, you can't outguess it. And so the stock picker who is setting up a fund to outguess the stock price is merely trying to earn fees, because the evidence is that folks, with very rare exceptions who aren't using inside information, won't succeed at the venture, so therefore you and me ought to buy an index fund. But, Young, is that the same claim you're making?
No, it's not.
No, it's not. And distinguish the two claims.
So I guess one is about you're kind of, One is about whether today's stock price reflects the intrinsic price that maybe that exists or not. The other is
What do you mean
about,
by that? I mean, put flesh
so
on
basically
that.
like how much value does like Apple have objectively, aside from the money value, like with the services and the products that it provides to people. So how much is that worth? Just to, so I guess, I mean, it's kind of hard to put in words, but basically, just like the value of a company aside from like speculation and more about what it does and its assets that it has and the cash flows that it'll generate. I think the other is about how what the market price will, how today's market price compares. That part is the same, but how it compares with tomorrow's market price, which is really different because tomorrow's market price will still just be a measure. It might be a measure of the intrinsic value. Maybe it's trying to get to it, but it would be a result not of what the company does, but what people playing the market do.
Okay, so notice the differences there and why they are important. The informationally efficient claim is only that today's price is the best predictor we have of tomorrow's price. That you really can't outguess it. You can't make, on the basis of the information that is available, nobody can systematically do a better job at predicting what tomorrow's price will be than merely looking at today's price. So trading profits are not possible to make on the basis of the information that's already available. The separate claim, which I'll say is a claim of allocative efficiency, is that the market price gives some measure of the economic performance of the firms. And it's the best measure. That's the efficient markets claim. And so, I mean, in a very meaningful way, it can really matter. So basically, assume you make semiconductors, right? And they're rivals in your business. And you see that your stock price has a PE ratio of 10, which is some way the market assumes how your earnings are going to be going in the future, the expected growth rate, et cetera. And your rival has a PE ratio of 15, which means it seems the market has a more favorable view of your rival's future earnings path. If you take that view, if you think that the stock price, the comparative stock prices, are giving you information about the comparative business strategies of the two firms, that the stock price it's an allocative signal. It tells how the two firms comparatively are making use of scarce economic resources. Then you as the CEO of the lower valued firm would think you ought to change the way you do business. And so if you take that view of what the efficient market claim is, then it becomes very important to think how you would use real economic resources and how you would compare the two CEOs in his or her business strategy. If you think merely that the only thing you can get from stock prices is, in a sense, measurement of the information that's available, it doesn't tell us very much about the allocative efficiency. Then there isn't much to be said beyond the fact that you can't make trading profits in deciding to buy firm A as opposed to firm B, given the price that is today, right? And so the reason I belabor this point is because of takeovers, right? So let's see. Mary Zaid Bar, is it? Marie? Is she here? Mary? No? Angel? Are you here? Yeah. So basically, you are a CEO of a firm that's faced a takeover bid. All right? The market price of your firm is $25 a share. The bidder is offering $40 a share. Whew. So, how are you going to defend against that offer? I mean, you need the mic.
I guess it'll depend on my valuation of the company. So if I think that $40 doesn't reflect the actual value of my company, then I might take measures, defensive measures against the offer. But if I think it's a good price for the shareholders, then I guess I have to accept it.
Well, the shareholders see a $40 a share offer. They see this trading price at $25. What are you going to say in the press release telling them why they should not accept the bid?
I might make estimates, or I might make a guess about what maybe the future board will do with the company, that it won't be in their best interest in the long term. Maybe they have plans that are contrary to...
No, you're the CEO. I want you to put it affirmatively, right? What are you going to say?
This offer isn't in the best interest of the shareholders in the long term.
Because
the offer doesn't align with the direction of the company, and in the long term, the share price might drop.
Well, if the price might drop, then surely it's pretty good to get out at $40 a share now, right? The bidder is going to pay cash. We need co-counsel here. You're Jacob?
Yeah.
Okay. You're not on my seating chart. Well, that's all right.
I am on the seat I registered for.
Go ahead. I'll have to print out a fresh one.
So,
yes, go ahead.
You'd say that the $25 market price only reflects the publicly available information which the market can trade on, but me as the CEO, I have all the information, and I actually predict a much higher price, which sort of brings me back to my question. If we said intrinsic value before, that means the actual value of the company. Can a market actually reflect that? Because the market price will only be based on the information available in the market, while the intrinsic value would be the actual value of the company, right?
Well, right, there are a couple different things going on. And here we should distinguish on a different dimension. So when we first started the discussion, Christian's point referred us to the kind of information that that the market would have access to in generating the market price. And so his example was the history of stock prices. And he basically referred to the fact that the weak form of a hypothesis, EMH hypothesis, was the market is efficient with respect to the information set that consisted of past prices. So that, for example, chartists who look at the history of stock prices and construct shoulders and pyramids and other tables of astrology to predict the market price. That's a pointless exercise because the market, at least to the history of stock prices, is fully efficient. That is to say, every last piece of information that one could squeeze out of the history of stock prices is already impounded in the stock price. So don't go there. And that's not a surprise because the history of stock prices is readily available, it's cheap, so of course you'd expect it to be impounded in stock prices. So, Jacob, what part of the EMH, what part of the information set are you now distinguishing between?
Well, that's one, the past information about how the stock price...
I'm sorry?
The past information you just talked about, and then there's also all the information the company or competitors put out there in the market, which then gets evaluated by the market and is then, according to the efficient market theory, how I understand it, more or less immediately, because they're so sophisticated investors, reflected in the stock price. So the stock price will give a fair market value based on all the available information in the marketplace.
Okay, so the second version of EMH, in effect, says there's a different set of information over which we think the market price is efficient. The set of information that is publicly available. And indeed, the semi-strong form of the hypothesis says that all the information that is publicly known about the firm will be, and its rivals and everything else about the world will be reflected in today's stock price. All right, so that brings us to the point you are making.
Yeah, so if I'm then the CEO of the company that's facing a hostile takeover bid, I have more information than the marketplace, so I could go out and tell my shareholders, based on the information which I have but not everyone else has, $40 isn't a good bid, and sort of make a claim or even put information out there that sort of will substantiate my claim that that is not a good bid.
All right, so the CEO on this account is saying I concede the market is semi-strong efficient. He or she is not going to speak in those terms because the shareholders would be very puzzled. But the market is not strong form efficient, which is to say the market price does not reflect all potentially knowable but not yet revealed information about the price. I have information, proprietary information about the firm, which if you knew, you would agree with me, $40 is an inadequate price for the firm in that tomorrow's price, if that information were fully disclosed, would be above $40. Okay? Now, Maggie, what would you question Jacob if you're now a shareholder and you hear him make that claim? Right. He's basically saying, trust me, I got the information, and you shouldn't sell at $40 a share. So question him. You're the shareholder. Put your query to him.
And we're assuming I really believe that markets are informationally efficient.
Yeah, you're with him as far as he's prepared to go, or question him on any dimension you want.
I mean, I think I might say...
Mike.
I think if I wanted to be really strong about this, I might say I don't think it's possible. I think unless you have inside information, in which case I don't want to.
He's the CEO.
Oh, sorry. So
he's the CEO making this claim.
Okay, sorry. So what am I arguing against? I don't understand.
You're
sorry.
You're lawyer for the shareholder who's got shares.
Okay.
That she might want to sell.
Sure.
And the CEO stands up at a meeting and says, you know, I got information. $40 is not a good enough price.
Oh, he thinks it's not enough. Oh, I
Yeah,
thought,
yeah,
okay.
he's basically saying you shouldn't sell. I might put a poison pill in.
Right, right.
So what's the question to him? What do you want from him?
Short of telling me exactly what this information is.
Yeah, show me the money, as it were, right? Tell me the. All right. I mean, if you have it, so tell me, and then I'll and everybody else can. Back up. The market will reflect today. If you reveal the information which you think will lead the stock price to go up above 40, guess what? The market price, upon the revelation of the information, will tell me whether to believe you. Okay? Because I'll now have the consensus view about that. So that's your query to him, right?
Sure, sure.
Right, as amended, right?
Yes.
Jacob, all right. So you have a response?
Well, the information is about this amazing new product which we're going to bring out in 2 years, which I can't reveal because our competitors will then go and produce the same thing. But I could then say I'm happy to talk to an investment bank to get a fair market evaluation and reveal some of the information confidentially to them, and they can give you a
Right.
valuation.
I'm going to hire the investment banks, and I'll reveal to them, and they'll give us a view, right? In unbiased. Yeah. Before you go to that story, right? Show me the money. I'll be prepared. I'll happy to give you a valuation. But no, the first part of the story is, you know, that's credible, right? I mean, or it might be. I'm working on a project, which, you know, the iPhone. Except if I reveal what I'm working on, Mike, back up step. So products have a life cycle. And any neat thing is for sure going to have imitators. Competitors are going to come in, and if I have a profit margin of 50% on the iPhone that I'm about to launch, the smartphone I'm about to launch, because it really does the very best. It's got a camera that like nothing you've ever seen. You know, it'll turn all of your photos into a video game magically, right? It's a good idea. And it'll make a huge amount of money. But in effect, I need a little monopoly. I need a period over which I'm the only one who's selling this device to really make the most money from it. And if I reveal in a premature way that I've got plans to do this, then then I'll be giving up competitively sensitive information. And from a shareholder point of view, you would not want me to do that, because then you would be, in effect, giving away some of your money to competitors because of what is now forced upon me to be the premature release of the information. So therefore, trust me, right? Trust me. Do not sell at $40 a share. It's not a good price. So, Maggie, what's your response?
I would say a bird in the hand is worth two in the bush.
Right. Yeah. You know what? Thank you for your view, but I think I'd rather have it $40 a share, right? Because, you know, talk is cheap. Jacob has got a great job. He doesn't want to lose the job, et cetera, et cetera. How credible is it that, in fact, even if he's got some new idea, how credible is it going to be that it's going to be worth that big a bump on the stock price? It's going to be in the future. The world could change. He may actually believe he's got a great idea, but he's obviously not prepared to launch the product today. So you know, I'd like to make the choice. I appreciate that that's his view. He's an honest fellow. But on the whole, I want to make the choice. And guess what? The worst that happens is the shareholders, lose value. Because if the hostile bidder were to take over and see he's got this great idea for a camera that turns, photos into a video game, they're going to pursue it. It's not like the value will be lost in the world. It's just that I, as a shareholder, will not be as rich as I otherwise would have been. But given the choice, I would want to have the $40 now than the chance for even more later. So so this is the kind of pivoting off the EMH claim. This is exactly the kind of debate which has been classic in the hostile bidder space. The market price, even if you believe the market price is efficient in reflecting all the information that is available there, the CEO still has a response. Yes, but the market doesn't know what I know, to which the shareholder has a counter response, which is to say, I get to make the choice, or I would like to be able to make the choice, please. Since I'm going to bear the cost of the choice, I want to make the choice. So, anyway, all right. Because implicitly, the hostile bidder is making a different sort of claim, which is relevant to the EMH, right? The hostile bidder is saying the $25 a share reflects, in a real way, the expected future cash flows of the firm under Jacobs' management. These are the resources of the firm, and the way he and his team have put them together are going to produce a firm that is worth $25 a share. But my management team is a better management team. And we can make better use of those real economic resources and can get out of them a firm that would be worth north of $40 a share. Right? And so that's the way in which the way in which the market price reflecting the intrinsic value of the firm comes into the story. Because at one level, the hostile bidder is saying the intrinsic value of the firm with Jacobs' team is $25 a share. The fundamental value of the firm with his team is $25 a share. I've got a better team. The value of the firm under my management is above $40 a share. They're efficiency gains of different types, which my management team can achieve. And so again, that's the way in which the $25 is under his management. That's the best predictor of tomorrow's price. It accurately reflects the expected future cash flows, but with better management, the firm might be worth even more. All right, so this is one way the EMH stuff spins out. Now, Maggie pointed to a paradox here that's relevant for kind of policy in this area, and that is when we say markets are efficient, we have to worry about, well, how do they become efficient? How do they become efficient? And the way that they become efficient is through the competitive activity of all of the market intermediaries especially securities analysts and stock pickers, trying to squeeze out the informational nuggets to earn trading profits, which by hypothesis we've said are not possible if the market is efficient. Right? Everybody see it? I mean, the market becomes efficient because we have these market intermediaries competing with one another to be the first to take the information from the earnings release or the government's projected corn production. What is that going to do for P&G or whoever makes Frosted Flakes, right? When it comes to the cost of their input and thus the margin on the Frosted Flakes, thus the earnings for the next quarter, et cetera. All these folks are trying to gather information and quickly use it to trade the individual stocks whose earnings might be affected by the fresh news. And yet, we've said that stock picking on average, it can't win. And, you know, so there's a paradox. Plainly, we don't want to ban securities analysis, right? Because if we banned securities analysis, taxed it out of existence, then markets would cease to become efficient. Similarly, if we barred stock picking and stock trading, markets would become inefficient. So the most refined version of the claim is that sophisticated parties whose business it is to discern and trade on information can earn a competitive rate of return on trading. Not nothing. They earn a competitive rate of return. In other words, if you're good at it, you can earn enough money to earn a living, but not to become truly rich, is one way to think of it. And the further claim is that unless you're really good at it, you're going to lose, right? Which is to say the rest of us who don't have 24 hours a day to devote to this game and are there sort of, you know, reading the news ticker every day, will be outcompeted and crushed by the folks who do this and are really good at it. So there's sort of a competitive rate of return from being a securities analyst, from being a person who tries to outguess the market price. And that's the chance to earn this competitive rate of return is what keeps folks going. It keeps, it attracts enough talent that prices become efficient is what it amounts to. And the rest of us get to free ride on the fact that the market price is an accurate reflection of tomorrow's price. Hedge funds. You know, obviously there have been great suspicions that the hedge funds are engaged in a very sophisticated sort of insider trading, and there have been various investigations and indeed prosecutions of some. But in general, some of the hedge funds who trade go to extraordinary length to try to gather new information, right? So hedge funds hire drones to sort of fly above the cornfields to get an estimate as to how the crop yields are going to go before the official government release of that information. So they can trade ahead of everybody else on how, you know, P&G or whoever makes Frosted Flakes is going to be doing in the next quarter. And you know, and so there's similar extreme examples of efforts by parties to gather information, and so you know this shades over into the discussions about insider trading, right? So in this you had last semester, I hope, or most of you did, and there's this whole debate about should a person in possession of an informational advantage be able to trade on the basis of the informational advantage. So if you have material non-public information of any type, should you be able to trade on it? And the classic American view, and the European view is a little bit different, is that if you yourself have created the information, you can exploit the informational advantage because, and this brings it back to EMH, markets will not be efficient unless parties have incentives. Back up. Markets will be much less efficient unless parties have incentives to try to go out and generate as much information as they can, which via their trading activity gets pounded in the market price. So the U.S. view is that if you have created the information yourself, if the informational advantage is not the result of insider leak or obtaining the information from a party from whom you have a fiduciary duty, like the investment banker who's doing the merger, if the information is not tainted in that way, then you have the right to trade on the basis of the informational advantage. And that is how market prices, one of the ways in which market prices become as efficient as they are. And so when Maggie says to Jacob, I appreciate your view, but I'd rather have the $40, what she is relying upon is that there are lots of parties there who are trying to figure out exactly what Jacob's firm is worth, and if there had been hints through supply chains or, gossip at the trade shows or whatever, that his firm was on the verge of a breakthrough that was going to, to transform cameras and video games, that would be reflected in the market price. And so the weight that she places on his claim that the price is undervalued is in effect conditioned by the incentives on all these intermediaries to generate new information to earn trading, which leads her to have greater faith in the $25 as the price that Jacob's firm is worth under his management's team oversight. So that's a little bit, that's how EMH and all the stuff, it connects up a lot of stuff that, that come from different areas. All right, so now we want to talk in any questions about this before we move on? So let's discuss bubbles. All right. If all these traders are working so very hard to try to produce prices that predict tomorrow's price, even if we aren't sure what their connection is to intrinsic value, the allocative efficiency claim, we can be sure that at the very least, the stock prices that the traders are looking for ways to to outguess the price, the market about tomorrow's price. So, I mean, in other words, the traders are surely trying to outguess the future choice of the future path of prices, right? That we know the traders are trying to do. So how do we get stock bubbles? How do we get prices? How do we get the dot-com bubble, where prices in '99 were way above where they were a year later? How could that possibly happen? Yeah. Let's see. Julie?
Yes.
Yeah.
Julia.
Okay,
Yes.
Julie. So.
Julia. Yes.
Julia?
Yes.
Okay, Julia.
I think
Oh,
that-
Julia.
Yes.
Okay.
It's
There's a
spelled
Julie
differently.
beside you who's
Oh,
not
yeah.
there. Okay. All right. Good. Go ahead.
I think that people overreacted somehow to information.
I'm sorry.
I think that people somehow overreacted to information.
Overreacted. Could you say a little more about that?
Yeah, I mean, probably, there was like certainly a positive trend on certain kind of companies that were making investment, and it was a good moment because, I mean, internet was developing and everything. But probably there was like too much enthusiasm that what should have been based on a rational analysis of the information that were available.
Okay, overenthusiasm. And you could maybe tell a behavioral economics story there, which we're... But why wouldn't a different group of traders say, you know, there's a lot of enthusiasm going around here. There's overenthusiasm. There's, in the famous words of Alan Greenspan, then the head of the chairman of the bank, the Federal Reserve Bank, there's irrational exuberance. So why couldn't the traders who are, after all, trying to make money say, you know, there are all these folks, they're like at a party. They've hit the bottle. It's predictable that there's going to be a crash. So I'll try to profit off this exuberance, over exuberance. So why didn't that work to keep the bubble from occurring? Why don't we see we're in a bubble? Let's say. Why are we in a bubble? What facts about the market mean? That's the issue, right? Why aren't the pessimists trying to take away the punch bowl?
I mean, couldn't it also be that, I mean, I'm not sure it's the answer to your question, but couldn't it also be that people were like, I mean, seeing other people trading, people thought that there was information on the basis of which those trades were occurring. So this inflated the bubble, basically.
So all right. So one idea is that there wasn't a bubble. People were smart people were predicting the future. The net was going to change. The internet was going to change everything. It did in a certain way. It's just not in a way that you can make money from it necessarily. Amazon has figured out how to make money from it, and Google and Facebook. But the pets.com of the dot-com boom did not figure out how to make money. So everybody was making a rational bet. It just didn't turn out. And so there are two different stories, right? And a kind of irrationality story, a rational story. Let me try to add a little bit of depth here and add a kind of a set of ideas. So and to try to explain in a systematic way why bubbles will predictably occur. We don't know when they. It's not like we can predict one. We will just, or any. It's not like we know when we're in a bubble. It's just that the structure, leads to a prediction that they will occur every now and again. All right, and so basically, I want to introduce the idea of the arbitrageur, the ARB. So let's imagine that we have a single commodity that trades in two markets. Gold. Gold in New York. Gold in Paris. Gold in New York trades at $50 a share. Sorry, at $50 an ounce. Gold in Paris trades at $35 an ounce. So, Julia, how are you going to make money here?
Buying in Paris and selling in New York?
Or vice versa, right? I mean, yeah, you'd buy in Paris at $35 an ounce, and then, you know, you'd magically send it across the Atlantic and you'd sell it in New York at $50 an ounce, and you'd lock in 50, and without risk, assuming that you can do these trades simultaneously, etc., you'll lock in $15 between the selling price in Paris, your buying price in Paris and your selling price in New York, right? So, so what does that tell you, predictably, about what the price of gold in New York and Paris will be? Will there, in fact, be gold to be bought at $35 in Paris and to be sold at $50 in New York?
It will eventually become even.
That's right. The actions of the ARBs, the arbitrageur activity, will essentially result in a single price for the same commodity in two markets, or however many markets it sells in. Now, everybody see how that works? And that's very neat and powerful, right? So, I mean, all you need is the information about what gold sells in Paris at a certain time and what gold sells in New York at a certain time, okay? The ability to lock in the spread means that the prices will converge to the true value given the supply and demand for gold at a given point in time. Now, the question is, why doesn't a similar process work for stocks? Because in effect, suppose the stock price is now selling at $50 a share. The stock price of some dot-com firm, or a tech firm today. A unicorn today, right? The stock price sells at $50 a share. But you, as a sophisticated party, looking at all the information that's available in the market, really thinks the cash flows from that firm support a stock price of only $35 a share, and the market in due course will trade the stock price at $35 a share. Right? So Julia, how would you make money on the basis of the same commodity, the stock price of unicorn, we'll call it, the same commodity trading in two markets, at a higher price here and a lower price here, why can't you just lock in the profits?
What I could try to do is like short sell today.
Yeah.
I mean, to like buy tomorrow at a lower price.
So what we've described is short selling, right? You basically you borrow 100 shares of unicorn stock at $50 a share. In the view that in due course, when the market price falls, you'll be able to buy the unicorn stock at $35 a share and return the stock that you've borrowed. Right? Again, you borrow the stock, you borrow 100 shares, 50 a share, you sell it, you've got your $5,000 in the different market in the future. When the stock price falls to $35 a share, you'll buy 100 shares at $35 a share, and you'll have $1,500 as the spread between the same commodity, unicorn stock, in different markets. So why doesn't that work? And the consequence is that your pessimistic view about unicorn stock will affect the market price of unicorn stock, and so that will be the information you have about unicorn stock not being worth $50 a share will actually be pounded in the trading price of the stock.
Yeah, because if people see that other people are short selling at 50, they probably believe that these people have information that, like, according to which the price will eventually drop at 35, so they're not willing to sustain the price.
Right, and so notice how this thing ought to work, right? The short seller, a person who has negative information about the stock, will be able to sell in New York and buy in Paris, or you borrow an ounce of gold in New York, you sell it at $50 a share, and you replace the ounce of gold that you've borrowed in New York by buying the gold in Paris and giving it to the New York lender, and the process there will narrow the spread to the true value of gold. Why doesn't that work for stocks?
Because people could not be willing to acquire the stocks for 50 or lend the stock. I mean, they have to be available available persons to trade.
Well, they'll lend it in the sense if you put up adequate security.
But you have to have someone who wants to acquire at 50?
Well, I've got the stock. I can lend the stock to you for a fee,
But if I sell short at 50, I have to find an acquirer who wants to pay 50.
But that's the market price.
But if the market knows that I'm betting against,
well, if the market collapses that fast, price that fast, but that would be pretty fragile price, I would suspect. Ideas? Jacob, go ahead.
I think most stock, or nearly all stocks, are only listed in one exchange, so you don't actually have that sort of simultaneous arbitrage thing.
What are the two? Wait. What are the two markets that I'm describing in the stock case? How are they different from the markets I described in the gold case?
The gold case is geographically different markets, and the stock markets are historically different. So you'll
are what different?
It's just like
different
the one thing
in
happens 2 weeks after
time.
the other.
Aha! So wait a minute here. The gold market the ARB knows exactly what the price in New York is and the price in Paris, and there's no uncertainty about it. If you buy in New York at 50 and sell in Paris at 35, at the same moment you're going to lock in your spread. There's no certainty cost about that. There's no uncertainty about that. The short seller in a stock market who's selling today in the belief that he or she can replace the stock at a lower price in the future, that's the point. There is no certainty about the price of this unicorn stock at the future time when you want to buy it to replace the stock that you've just borrowed. And there is risk. There is no risk here. When you buy at 50 to sell at 35, there is no risk. You know what the prices are. I mean, there's the usual commercial risk that you're cheated, but there's no risk. The ARB who's trying to deal in the stock market faces risk because he or she is betting about the future price, the price that is predicted on the basis of her information but is not certain. She could be wrong because, first, maybe she's misjudged the unicorn's actual business. He or she thought that Uber was just this crazy idea and, you know, pretty soon everybody would realize that being able to hail a cab on the street is much better than, you know, hailing a cab licensed by the city of New York, much better, safer. Who would want to tap into a phone and get a driver you never heard of? This Uber is a flash in the pan, so I'll borrow Uber stock, which is not traded, but Facebook, right? I mean, or Google. How, you know, I sort of remember when Google went public, you know, a lot of folks just thought it was at this inflated price, you know, could not possibly be worth that, right? So anyway, when it came to this unicorn stock, which she is sure is going to fall from 50 to 35 because the business is a crazy business, she could be wrong in a sense about the fundamentals of the business, right? So there's risk about the fundamentals of the business assessment that leads to 50 versus 35. There's also uncertainty about the point at which the market will come to its senses. Even if the business model of unicorn will eventually collapse, and people really ought to know, there's this famous line, you know, the market's got the capacity to be crazier than you, the short seller, have the capacity to hang in, right? Because the longer, because the unicorn stock might be overpriced at 50. But that doesn't mean it might not go to 65 or 70. And you, as the short seller who has agreed to return the stock that you borrowed and sold at 50, are facing bigger and bigger potential losses, right? Because as the stock goes from 50 to 60 to 70, the cost to you of potentially having to replace the stock at a higher price than what you sold it at is going to increase. So you're facing greater and greater risk if the market, if either your judgment about the business is really wrong and the stock price deserves to go up, but even if you're right that it's a bubble, the point at which the bubble collapses is not knowable, and in the meantime the stock price might be going further and further up. So and you're having to institutionally, the person who lent you the stock is going to be wanting security to replace the shares, and it becomes expensive to maintain the short position. The bottom line is that the amount of short selling is undersupplied. The arbitrage activity on the negative side is undersupplied. Which means that markets will have an asymmetry between the pessimists and the optimists, right? If it's costly to express negative sentiments, then markets will be undersupplied in negative sentiments. You know, it's sort of like, think of a bubble in a tube, right? I mean, maybe this metaphor doesn't work. It's going to say if you were to put pressure on the tube, the bubble ideally would come out symmetrically, but if one part of the tube is capped, then it'll express itself only in one direction. So I'm not sure that adds to the intuitions here. But the point, and I think this is a really important point, is precisely because short selling is costly, the positive bubble is a more likely phenomenon than the negative bubble, is what it amounts to. I mean, there's a third point. The ARB is not in the business of providing a social service of correct stock prices. Rather, the ARB is in the business of making money. And if the ARB thinks that there's a lot of craziness in them thar hills, people are delirious about the future of the future, then the ARB will predict that Unicorn, if it's overpriced today, will be even further overpriced in 2 months, because the overenthusiasm is really accelerating. And so the ARB will not merely be, I mean, again, the ARB's prediction about the future is based on whatever is out there in the world. And if the ARB observes that there is a lot of excess enthusiasm for unicorn-type stocks, then that will lead him or her to have a prediction about the future, and that future could be that the unicorn stock price will be 65, not 35. And so instead of selling short, the ARB will be predicting that the stock price, because of these extrinsic factors, will be 65. And so when you hear about momentum traders, it's not a fundamental value. What are the earnings of this firm going to be? The intrinsic value. That's not the point. The point is, what is the stock price going to be in 2 months? And if I think that folks are really crazy, then the stock price is going to be higher, even if this firm will never earn a penny. And so, and so that's another reason why we might imagine that we'll see bubbles, positive bubbles, where stock prices get really out of line. Yeah. Who had their hands up? Did I see a hand? Oh yeah, I'm sorry. David.
So then what ultimately makes the bubble pop?
Aha.
That's the top question.
What makes a bubble pop? Ever see the cartoon The Roadrunner? Right, I mean, it's kind of, the metaphor is famous, right? The Roadrunner runs off the cliff and manages to go for quite a while until the Roadrunner looks down, at which point the Roadrunner plummets. So, reality bites, as it were. So the financial crisis was the bubble associated, the real estate bubble that drove the crisis collapsed when when the rate of mortgage defaults became very high, and that news was unavoidable, right? And so that's the moment of looking. That's the moment when gravity overcomes bliss, I guess, right? So basically, a lot of the mortgage-backed securities depended upon a very low default rate for their value because of the cash flow from the mortgages, and as as housing prices went higher and higher, but incomes were basically flat, people's ability to service the mortgages became less and less, which predictably meant the number of defaults increased, which, again, when that news got disseminated, all of a sudden, everybody realized at once, as it were, that the present value of the mortgages was not sustainable, and, boom, the value of the assets corrected rather dramatically. So that's part of it. Another thing is anyway. So that's except you don't know when. That's part of the point. Even if you thought that in 1996, I mean, the dot-com bubble is an example I come back to because we have the beginning, middle, and end, and enough to say that it was an actual bubble. Right? In 1996, Alan Greenspan said irrational exuberance. He thought markets were overpriced. I think the Dow was at about 6,500. And there'd been an unprecedented run-up in the Dow. By the time the Dow actually, the bubble hit, the Dow was over, was about 10,000. So if you had sold at the time that an extremely sophisticated market observer said these stock prices are irrationally exuberant, you would have missed, almost a 50% gain in the stock prices. I mean, the market fell, but only to 9,000, right? I mean, now the NASDAQ fell by more than that, but it's sort of like to be observing what seems to be a bubble doesn't tell you much as to when the bubble is gonna collapse. Except, you see, the one thing we know is that the institutions of the expression of negative sentiment, it's very hard to express negative sentiment in the marketplace, right? To sell short, and here I'm speaking in a very broad sense way, it's costly. It's costly in the sense you might be wrong. It's costly in the sense that you have to finance a position, which becomes more and more expensive to hold as the market prices go up. You've really got to have an iron stomach because as the losses mount, your belief that the stock price is high becomes tested. So you're going to have a biased result in the market price, biased up. there's no limit to how high stock prices can go. I mean, if the stock price now trades at 50, it can only go to 0 on the downside, but it could go, you know, to 1,000, as it were, if you're Apple, right? And so there's a kind of a negative asymmetry here, and of course there's also this cultural odor associated with selling short, with being on the negative side. It's sort of like you're betting for things to go badly, and you know, so that can be hard to do. You're betting against the positive view of the future. You know, I mean, if you were to bet against the market that we've got now, right? You're betting against some positive view of you know, how it'll all go. But I mean, there's another sense. The point, going back to your point, David. One way to think is how many folks are still pessimistic. So if everybody has been converted to an optimistic view, then that's the point to get really scared, because there's no more fresh money coming in to keep prices going up. The famous adage, there's a famous adage, is that, you know, a good bull market climbs a wall of worry. And so some have observed that the present stock price rise is, to some extent, a melt up. That everybody who's been on the sidelines now thinks that, you know, in a sense, I got to get in now because tomorrow's stock price is bound to be higher. And I mean, if that's the psychology on the basis of which housing prices were able to escalate for a long time, right? If I ever want to buy a house, now is the time, because when I, you know, have the 4 kids, unless I buy now, I won't be able to afford it when it's, you know, in 5 years. So that anticipatory sense that the market prices have to go on up forever is maybe also a negative sign. But as I say, folks were sure in 1996 that the market was about to crash, and it was 3 years before the correction took place. So, you know, I'm not offering any investment advice here, except diversify, right? It's the only advice. All right, so let me sum up by saying, in thinking about efficient markets, I mean, there's a huge amount that's really important in the way we understand how M&A works, how financial markets work. That's embedded in the question as to what today's stock price mean. The thinnest version of EMH is, coming back to where we started with Christian, it means today's stock price is the best estimate of tomorrow's stock price, right? So that doesn't require the substance of that is pretty thin, right? It's not it's an important claim, but not, but it is a claim merely about a limited claim about what today's stock price is about. The deeper claim that today's stock price reflects intrinsic value, fundamental value, that's a deeper and harder claim to sustain. You could both believe that the market price today is efficient in the informational sense, that today's price is the best guess about tomorrow's price, and also believe that you are a skeptic as to whether the price today of unicorns actually says much about the fundamental value associated with that class of stock, right? The allocative claim, that's a different claim associated with what today's stock price means. Okay, so tomorrow we're going to begin discussion of event studies. That will take place for two days. It's a very demanding set of materials.